Hey everyone, welcome back to Corporate Dakota, the place where we break down the complex and sometimes wild world of corporate finance and get to the juicy bits, so buckle up, because what we have today for TAO Synergies Inc. might just raise an eyebrow or two. This is your invitation to their annual shareholder meeting, a crucial event where big decisions get made, and we're going to decode exactly what they're asking you to approve and why it actually matters before we dive in. If you are a fan of getting clear, no fluff insights into what companies are really up, to make sure you are subscribed and hit that notification bell. We also have a fantastic community over on our Discord server, linked right below in the description, so come hang out and level up your investing game with us. So, TAO Synergies Inc., formerly known as Synaptogenics Incorporated, is gearing up for their 2025 annual meeting of stockholders on the 18th of December, and they are holding it completely online, which in today's world is not that unusual anymore. But the real story is what they need your go-ahead to do. First up, they are asking you to approve a pretty substantial issuance of new shares. The company is looking to author issuing shares of its common stock that are tied to convertible preferred stock and warrants they issued. This is in connection with a securities purchase agreement from October 2025 and an engagement letter with GP Number Incorporated as their placement agent. The amount they are talking about is more than 20% of the company's existing common stock outstanding before these new shares are actually issued, and this includes any shares that might come from anti-dilution clauses, which basically means if the stock price drops, they might have to issue even more shares at a lower price to protect the investors. That is a big deal, folks. Now, why are they asking for this approval? Well, it is all about the Nasdaq stock market rules, specifically listing rule 5635D, which generally requires shareholder approval before a company issues more than 20% of its outstanding shares in a private placement. Like this, their reason for this financing was to raise additional funds for general corporate purposes and to keep acquiring Bittens DAO as a treasury reserve asset. They got about $11 million in gross proceeds from this financing, which they say was essential for their cryptocurrency treasury strategy, and honestly sounds like a pretty bold move to build up their digital asset reserves. Let's talk about the specifics of what they are selling. The company entered into this securities purchase agreement to sell convertible preferred stock and warrants. The Series E preferred stock is initially convertible into up to 1.375 million shares of common stock at a conversion price of $8. Per se, that conversion price can be adjusted if the company issues shares at a price lower than that, then investors get more shares to compensate them for their investment. It's a way to protect the investors from immediate dilution if the stock price drops after they invest. They also issued warrants to buy up to another 1.375 million shares of common stock at an exercise price of $8 per share, and get this, trees even warrants for the placement agent GP Number Inc. to purchase 4% of the shares issuable upon conversion of the Series E preferred stock. So another 55,000 shares are potentially being issued through these warrants. This is where it really gets interesting. Nasdaq listing Rule 5635D requires a vote because the potential issuance of all these shares, both from the convertible preferred stock and the warrants, could represent more than 20% of the company's outstanding common stock. Basically, they need your okay to issue a significant chunk of new stock, which will dilute existing shareholders. Share ownership. This is why they emphasize that if you don't approve this proposal, the company might have to pay out substantial cash amounts to these investors, which they admit they probably do not have enough funds for. So it's either issue more stock and dilute shareholders, or face a potential cash crunch. Beyond the share issuance, the company is also asking for approval to amend their 2020 equity incentive plan. The plan is designed to attract and retain key employees and directors by giving them stock options and other equity awards, and they want to increase the number of shares available under this plan by another 500,000 shares. As of the 31st of October 2025, they have about 2.2 million shares still available for future awards, but they are saying that is not enough to keep up with their future needs, so they're looking to boost the total shares authorized from 2.675 million to 3.175 million. This is a pretty standard move for growing companies trying to incentivize their team, but it still means more potential dilution for shareholders when these awards are granted. The TAO Synergies Inc. 2020 Equity Incentive Plan has been amended several times since its inception in 2020, and this latest proposal is just another step in that process. The company believes that effective stock base compensation is vital for future performance and for maintaining a competitive edge in attracting and retaining talented personnel. They are particularly keen on aligning employee and stockholder interests and linking compensation to company performance. This proposed amendment is key to allowing them to continue offering these long Term equity incentives, the plan itself has some good governance aspects like no discounted options, no repricing without shareholder approval, and minimum vesting periods, which is always good to see. Moving on to something a bit more routine, they are asking you to ratify the appointment of Stefano Slack LLC as their independent registered public accounting firm for the fiscal year ending the 31st of December 2025. Stefano Slack has been their auditor since October 2024. Before that, it was Morrison Cogen LLP now. Looking at the fees for these auditors for 2024, the company paid fees of $178,603, which is a bit lower than the $188,829 paid. In 2023, this is a standard part of the proxy process, ensuring that an independent firm is looking over the company's books. For the year 2024, total fees came in at $178,603, which is a slight decrease from the $188,829 in 2023. That was paid to Morrison Cogen LLP, the audit committee reviews these fees and ensures the auditor's independence. It is essentially a check and balance to make sure the financial reporting is being done correctly by an external party. Finally, there is an adjournment proposal, which is basically a safety net if there aren't enough votes to approve the main proposals like the share issuance or the equity plan amendment. The company wants the ability to push back the meeting date. This gives them more time to get the necessary votes to pass these key items. So if you see this proposal, it means they might be a little worried about getting enough shareholder support on the other items. This is pretty common in these types of meetings as a protective measure for management. Now let's quickly touch on who is running this show and how they are compensated, looking at the summary compensation table for 2024. Robert Weinstein, the CFO, Executive Vice President, and Secretary, took home a total compensation of $565,876. That includes his salary and a notable $100,000 bonus for his work in 2024, and for 2023, his total comp Accession was slightly higher at $568,918. Dr. Alan J. Tuchman, who was formerly the CEO and is now a consultant, received less compensation, as expected, with a total of $278,234 in 2024 and $303,347 in 2023. This looks like a company that is managing its executive payroll carefully. It's worth noting that Daniel Elcon MD, who was formerly President and Chief Scientific Officer, resigned this year in June 2025, and the compensation details reflect his role, ending his compensation for 2024 was $350,000, and for 2023 it was $375,000. The slight decrease might be related to his transition out of his full-time officer role. When we look at who owns the company, the table shows that as of the 31st of October 2025, there are no single stockholders known to own more than 5% of common stock. This means ownership is pretty spread out among smaller holders and management. That is not necessarily bad, but it does mean that management has a large influence on shareholder votes, since no single investor is likely to have enough shares to unilaterally sway a vote. The company has outlined its board structure and committee responsibilities. The board has 4 members: Bruce T. Bernstein, Joshua N. Silverman, William S. Singer, and Robert Efron. 3 independent directors are noted: William S. Singer, Bruce T. Bernstein, and Robert Efron. The board meets regularly, and they have audit, compensation, and nominating and corporate governance committees, all of which seem to be functioning with independent members, which is a positive sign for good corporate governance. It's worth mentioning their policy on related party transactions. Basically, any deal involving directors or top executives needs to be approved by the audit committee. If it is for more than $120,000, they also state that since the 1st of January 2024, they have not engaged in any such related party transactions, which is a good sign of clean dealings. So what is the big picture for TAO Synergies Inc? They are clearly in a growth phase, needing capital to push forward with their business plans, specifically their cryptocurrency treasury strategy. This means they need to issue more shares to fund these operations. The request to issue over 20% of their stock, along with the plan to increase share availability for equity incentives, indicates a significant focus on expansion and team building. However, this also means dilution for current shareholders, which is a trade-off they are asking you to accept for potential future growth. The company does seem to have good governance in place with independent committees and clear policies on related party transactions. Your board of directors recommends a vote for items 1, 2, 3, 4, and 5, which essentially means they are pushing for approval of all these proposals, including the significant share issuance and the equity plan amendment. The most critical one is the issuance proposal because it directly impacts your ownership percentage and the company's future funding capabilities. You'll need to weigh the potential for future growth against the immediate dilution of your existing shares. Consider if their strategy with this new capital and talent incentives is likely to pay off in the long run. Alright, that is our deep dive into TAO Synergies Inc. Latest proxy statement. What is your take on this massive share issuance and their digital asset strategy? Will it pay off, or is it just a way to fund ongoing operations? Let us know your thoughts in the comments below. If you found this breakdown helpful, please give it a thumbs up. It really makes a difference. And of course, subscribe to Corporate Decoder for instant access to more of these critical analyses. Don't forget to join our Discord community. Check the link in the description below. We love having these conversations there with all of you. Thanks for watching, and we'll see you in the next one.